There's a date on the calendar that most people over 60 have never heard of, and it is going to quietly decide whether you keep $6,000 or hand it back to the government without ever knowing you had a choice. That date is April 15th, 2026. That is the day your 2025 federal tax return is due, and it is the very first year a brand new deduction becomes available to Americans aged 65 and older. It is worth up to $6,000 per person. $12,000 for a married couple where both of you are 65 or older. And here is the part that should make you sit up. This deduction is not permanent. It exists for tax years 2025, 2026, 2027, and 2028. And then under current law, it is gone. So the clock is not a marketing gimmick. The clock is written into the law itself. You have a window, it is already open, and it will close. Let me tell you exactly what unlocked. In the summer of 2025, a large piece of federal legislation was signed into law, and buried inside it was a provision the IRS now officially calls the enhanced deduction for seniors. If you are 65 or older, this new deduction lets you subtract up to $6,000 from your taxable income. That is on top of your regular standard deduction, and it is on top of the extra standard deduction seniors have always gotten for being over 65. So this is a third layer. A brand new third layer that did not exist on any tax return you filed before 2025. Now, I want you to hear the difference between this and everything you have filed in the past, because it is the difference that matters. For 2026, the regular standard deduction is $16,100 if you are single, and $32,200 if you are married filing jointly. On top of that, seniors 65 and older get an additional standard deduction, which for 2026 is $2,050 for a single filer or $1,650 per qualifying spouse if you are married. Those two things you may already know about. But this new $6,000 senior deduction is separate from both of them, and it stacks right on top. For a married couple where both spouses are 65, that new layer alone is worth $12,000 of income you no longer pay federal tax on. This is real, it is federal, and it is in effect right now. Now here is where most people make a mistake, and I need you to not make it. The second some folks hear the words tax deduction, they think, that is for wealthy people. That does not apply to me. My income is too low. And other folks think the opposite. They think, my income is probably too high. I am sure I got phased out. No point in watching. I want to talk to both of you because both of you may be wrong, and being wrong here has a real dollar cost. Let me take the lower income worry first. You do not need to be rich to use this. In fact, this deduction was designed to help retirees living on fixed incomes, people getting by on Social Security, a pension, a modest required minimum distribution from an old retirement account. The full $6,000 deduction is available if your modified adjusted gross income is under $75,000 as a single filer or under $150,000 as a married couple filing jointly. That covers a very large share of American retirees. If you thought you were too small to matter to the IRS, you thought wrong. This was practically built for you. Now, to the higher income folks who assumed they were disqualified. Do not assume. The deduction does phase out, but slowly, and it does not vanish the moment you cross the line. If you are single and your income is between $75,000 and $175,000, you still get a partial deduction. If you are married filing jointly, that partial range runs from $150,000 all the way up to $250,000. Here is exactly how the phase-out works so you can do the math on your own kitchen table. For every $1,000 of income above your threshold, the deduction shrinks by $60. So a married couple earning $200,000, which is $50,000 over their limit, still keeps a $3,000 deduction. Not zero. $3,000. Read those numbers before you decide you do not qualify. I do not usually make videos with a countdown clock in them. That is not my style. My name is Emma Smith. I have spent years sitting across the table from retirees, widows, and families trying to make fixed income stretch. And most of what I teach on this channel is evergreen. It works whether you watch it today or next spring. But this one is different, and I am making it now because I have no choice. The window on this deduction is real and it is time limited. And every filing season that passes without you claiming it is money that is simply gone. It does not roll over. You cannot go back 4 years later and grab it. Let me also say plainly what I always say, because you deserve to know it. I do not make a dime from whether or not you claim this deduction. I am not selling you tax software. I am not an affiliate for a filing service. Nobody pays me a commission when you keep your own $6,000. Everything I am about to tell you comes from IRS publications and the text of the law itself, and I will list my sources so you can check every single number. And because taxes are personal, please do confirm your own situation with a licensed tax professional or directly with the IRS before you file. I am giving you the map. Your own preparer helps you walk it. Now let me show you exactly what to do and when. So here is your first block of action, and I want you to do this part this week, not next month, this week. The first thing you need to confirm is the single most important qualifying fact, which is your age. To claim this deduction for the 2025 tax year, you must be 65 or older by the last day of that tax year, December 31st, 2025. And there is a quirk in the tax rules that works in your favor here. The IRS considers you to be 65 on the day before your 65th birthday. So if your birthday is January 1st, you are treated as having turned 65 the year before. If you were born before January 2nd of the relevant year, you are in. Let me make this real with a name. Picture a woman named Marlene, 66 years old, living outside Columbus, Ohio. She lives on Social Security plus a small pension from a school district, and her income lands around $42,000 a year. Marlene assumed for months that some big new tax break must be for other people. This week, the only thing Marlene needs to do is confirm 3 facts. 1, she is over 65. 2, her income is under $75,000. 3, she has a valid Social Security number. All 3 are yes. That is the entire qualification check. It took her about 10 minutes at her kitchen table with her Social Security statement in front of her. You can do the exact same thing this week. Now, here is the second thing to confirm this week, and it is the one that trips people up. You need a valid work-authorized Social Security number to claim this. If you are married, you must file a joint return to claim it. Married filing separately does not qualify for this deduction at all. So if you and your spouse have been filing separately out of habit, this week is the week to sit down and ask a tax professional whether filing jointly would open this door for you. For many couples, it will, and the difference can be $12,000 of deductions you are currently leaving on the table by filing the wrong way. Pull last year's return out of the drawer this week and just look at which box is checked. And one more this week task, because I do not want you tripped up by a myth. You do not have to give up your standard deduction to get this. This is the detail that makes this deduction so unusual and so powerful. The old extra senior deduction was only available if you took the standard deduction. This new $6,000 deduction is available whether you take the standard deduction or whether you itemize. Read that again, because almost nobody understands it. Itemizers get it. Standard filers get it. So this week, you do not need to change how you file to unlock it. You simply need to know it exists and make sure it ends up on your return. Now, here is what changes as we move into the heart of filing season, roughly the stretch from late January through the middle of March. This is your second action block, and it is about the paperwork. Because here is the truth that this entire channel is built on. Being eligible for this deduction and actually receiving it are 2 completely different things. Eligibility does not mean the money shows up. Nobody at the IRS is going to call your house and say, "Congratulations, we noticed you turned 65. Here is your $6,000. You have to claim it. If you do not put it on the return, it does not exist as far as your refund is concerned. So let me give you the exact form. For the 2025 tax year, The enhanced senior deduction is claimed using Schedule 1A of Form 1040, which the IRS titles Additional Deductions. That is the document where the $6,000 deduction actually lands on your return. If you use a tax preparer, this is the moment to say a specific sentence to them. Say, I want to make sure you are claiming the new enhanced senior deduction on Schedule 1A. Write that down, Schedule 1A. If your preparer looks at you blankly, that is exactly why you needed to know the form name yourself. Let me give you a second name so you can see how this plays out. Picture a couple, Raymond and Denise, both 68, living in a paid-off house in Tucson, Arizona. Their combined income from 2 pensions and Social Security is about $90,000. Because they are both over 65 and filing jointly, and because $90,000 is well under their $150,000 threshold, they qualify for the full $12,000, $6,000 each. But here's the trap they almost fell into. Their software from a prior year did not automatically know about a deduction that did not exist yet. When Raymond sat down to file this season, he had to make sure his updated software actually applied the new line. He caught it. $12,000 of income shielded from federal tax. Do not assume the software catches everything. Verify it. Before this mid-season stretch is over, there is one more thing to line up, and it is your Social Security benefit statement, the form called the SSA-1099. You need your total income figured correctly to know where you land in the phase-out. Now, here is a piece of good news that most people get backwards. Whether or not you have started collecting Social Security has nothing to do with qualifying for this deduction. The only thing that matters for age is your birth date. You could be 66 and still waiting to claim Social Security at 70, and you still get this deduction. So gather your income documents now, this stretch of the season, so that when you sit down to file, the math is already done and nothing is left to a last-minute guess. Now here is the third and final action block, and it splits into 2 clocks that you have to watch at the same time. The first clock is the hard filing deadline. For your 2025 return, that is April 15th, 2026. If you file on time and you claim the deduction, wonderful, you are done. If you filed already and forgot it, you are not out of luck, but you are on a shorter leash than you think, and I will come back to that. The second clock is the one almost nobody sees, and it is the reason I called this video a deadline alarm. This deduction only exists for 4 tax years: 2025, 2026, 2027, and 2028. After that, under current law, it disappears. So this is not a one-time decision. This is a 4-year window you need to plan around deliberately. Let me explain why the 4-year clock matters for your money, because this is where smart planning turns into real dollars. Many retirees hit what advisors call the income valley in their early retirement years. That is the stretch after you stop working, but before your required minimum distributions kick in and push your income back up. During that valley, your income is often at its lowest, which means you are most likely to qualify for the full $6,000 deduction. This is the exact window some people use to do things like Roth conversions, moving money from a traditional retirement account into a Roth. But be careful, because a big conversion can spike your income for the year and push you into the phase-out. So the planning move is to size any conversion so it does not blow past your threshold and shrink this deduction. Let me give you a third name to make that concrete. Picture a man named Curtis, 65, recently retired, living in Asheville, North Carolina. Curtis has a low-income year right now, around $55,000, because he is not yet drawing on his largest retirement account. He qualifies for the full $6,000 deduction. Curtis is thinking about converting some of his traditional account to a Roth this year. The lesson for Curtis is simple. If he converts a modest amount and keeps his income under $75,000, he keeps the whole deduction and lowers his future taxable income at the same time. If he converts too much and shoots past his threshold, he starts giving that deduction back at $60 per thousand. This is why the 4-year window is a planning tool, not just a checkbox. Now, one important clarification before we go further, because I do not want to mislead you on a related point. This deduction lowers the income you pay tax on, but it does not change something called your modified adjusted gross income for Medicare purposes. If you have ever heard of IRMAA, the surcharge on Medicare Part B and Part D premiums for higher income seniors, this deduction does not raise or lower that calculation because IRMAA is figured before below-the-line deductions like this one. So claiming this will not accidentally push your Medicare premiums around. It simply lowers your federal income tax. I mention it because I want you to act on accurate information, not half information. And here is what to do if you have already filed your 2025 return and you realize, watching this right now, that you missed it. Do not panic. You can generally file an amended return using Form 104-0-X to correct it and claim what you were owed. There are time limits on amending, so this is exactly the kind of thing to bring to a tax professional promptly rather than sitting on it. The point is, the door is not necessarily slammed shut just because you already filed. But the longer you wait, the more you are gambling with those deadlines. So if that is you, put this on your list for this week, not someday. So let me tell you plainly what happens to the people who miss this, because it is not dramatic, and that is exactly the problem. Nothing happens. No letter arrives. No penalty, no warning. The money just quietly never comes to you, and you go on with your life never knowing it was there. That is the cruelest kind of loss, the kind you never feel because you never see the thing you lost. A single senior in the full deduction range who forgets this line is potentially overpaying on $6,000 of income. Depending on their bracket, that can be hundreds of dollars, real dollars, gone for good for that year. Now multiply that across the window. Remember, this deduction lives for 4 tax years. A married couple who both qualify for the full $12,000 deduction and who miss it every single year through simple lack of awareness are walking past $12,000 of shielded income, 4 years in a row. That is $48,000 of income over the life of this provision that they could have protected from federal tax and instead handed over without a fight. I am not telling you that to scare you. I am telling you because the whole reason this channel exists is that eligibility is not the same as receiving. The government wrote the benefit. Whether you actually get it is entirely up to whether you claim it. And I want to name the quiet villain here because it is not a scammer and it is not a greedy official. It is inertia. It is the habit of filing the same way you filed last year because that is how you have always done it. Tax law changed underneath you in 2025, and your old habits do not know that. The couple who use the same checklist they used in 2023 will file a perfectly correct-looking return that is missing thousands of dollars, and it will sail right through because leaving a deduction off is not an error, the system flags. It only flags what you claim, not what you forgot. That is why you, personally, have to be the one who remembers. And that brings me to something I have to warn you about, because every single time a new benefit for seniors makes the news, the scammers come out within weeks. So hear me clearly. The IRS will not call you on the phone to help you claim your $6,000 senior deduction. The IRS will not text you a link to sign up for it. The IRS will not email you asking for your Social Security number or your bank details to release this deduction. There is no sign up. There is no special enrollment. There is no fee to claim it. If anyone contacts you offering to get you your new senior tax break for a processing fee, that is a scam. Full stop. Hang up. Delete it. The only place this deduction happens is on your actual tax return, filed the normal way, through a preparer you chose, or software you trust, or by paper directly to the IRS. Nobody legitimate needs to call you about it. If you want to verify anything I have said today, you go to irs.gov yourself, or you call the IRS using the number printed on their official website, not a number someone gave you over the phone. And please, tell the seniors in your life this part especially. The people who most need this deduction are exactly the people the scammers target. Protecting the benefit means protecting yourself from the people who will pretend to help you claim it. If you remember nothing else from this entire video, remember this one action. Before you file your 2025 taxes, confirm out loud, to yourself or to your preparer, that the enhanced senior deduction is on your return on Schedule 1A. That is the one priority action. Everything else we talked about, the phase-outs, the Roth timing, the joint filing, all of it flows from that single moment where you make sure the deduction is actually claimed and not just theoretically available to you. Say the sentence, put it on the form. That is the whole game. And here is the part I saved for the end, because there is one more deadline hidden inside this one, and it is the one nobody sees coming. Everyone is watching April 15th, 2026 as the deadline. But the real deadline that will cost people the most is the end of each low-income year in your early retirement. Because the years when you qualify for the full deduction are not guaranteed to last. The moment your required minimum distributions begin, usually in your 70s, your income can jump and push you into the phase-out, shrinking or erasing this deduction, even though the law still technically offers it. So the hidden deadline is not just a date on a form. It is a stage of your life, and it is quietly ticking right now. The years you are in today may be the most valuable years this deduction will ever have for you. So do not treat this as a one and done. Treat it as a 4-year strategy that starts with this year's return. Make sure it is claimed for 2025. Plan your income for 2026 with the $75,000 and $150,000 thresholds in mind. Do the same for 2027 and 2028. And if you are doing any Roth conversions or big withdrawals in these years, coordinate them with a tax professional so you do not accidentally price yourself out of a benefit you were meant to have. The people who plan this across all 4 years will get dramatically more out of it than the people who stumble into it once and forget. Now, I know I just gave you a lot of numbers, and I do not expect you to hold all of them in your head. So I made you something. I put together a free 1-page senior deduction checklist that lays out every single thing we covered today in plain language: the age rule and the December 31st cutoff, the income thresholds for single and married filers, the exact phase-out math at $60 per thousand, the form name, Schedule 1A, the joint filing requirement, and the 4-year window with a simple planning box for each year. It is the whole video boiled down to one printable page you can put on the refrigerator or hand to your tax preparer. You can grab it free at the link right below this video at lead magnet URL. There is no charge, and I am not going to sell you anything. I told you at the start that I do not make a dime from whether you claim this, and I meant it. The checklist exists for one reason, so that when you sit down to file, you do not forget the line that matters. Print it, fill it in, and take it with you. And of course, this checklist is a starting point, not tax advice for your specific situation, so verify the details with a licensed professional before you file. But it will make sure the conversation with that professional starts in the right place. And now I am going to ask you to do something today, not next week, because next week is how good intentions turn into missed deadlines. Think of one specific person in your life who is over 65 or getting close to it. A parent, a sibling, a neighbor, the friend from church who lives alone and does her own taxes at the kitchen table every spring. Picture their actual face right now. That person may be about to file a return that leaves $6,000 of deductions off the page, and they will never know it happened. Nobody is going to tell them. The system does not send warnings for what you forgot to claim. So send them this video today, not later. Today, while it is in front of you and their face is still in your mind, because the deadline on this is a real date, and every week that slips by is a week closer to a filing that cannot be undone easily. You do not have to explain any of it yourself. Just share it and say, watch this before you file. It could be worth thousands. That one small act from you might be the only reason someone you love keeps money that was always meant to be theirs. This is the kind of thing that, once the window closes, cannot be reopened. So share it now. And if you want me to keep sounding the alarm on things like this, the deadlines, the deductions, the windows that open and close quietly while nobody is watching, then subscribe and tap the bell. When I say the bell, I mean it literally, because the whole point of this channel is that some of these opportunities are time sensitive, and a video that reaches you 3 months too late does you no good at all. The bell is how you find out while there is still time to act. I do not make deadline videos often, but when I do, It is because the clock is really running. Confirm your deduction, share this with someone who needs it today, and I will see you in the next one. Take care of yourself and take care of your money.